Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Eric, is there any evidence that we're going into a bear market?
Well, just look at the zoos. They're like all the bears now. I tell you what, if you read anything online, there's a lot of people that are calling for the imminent crash.
Yes,
the bear is coming. It's going to eat us alive. So,
well, we're long in the tooth, and you know how the markets have been up, the bulls have been running. Portfolios have not all, but a lot of them have regained or caught even made some money. And this is what they kind of that fake they talk about where the market drops dramatically, it rises dramatically. Everybody feels like, well, we got that out of the way, and all the individual investors dive in, and the institutional investors get out, and then that's where we go back to, gosh, we screwed up again.
Right, and as individuals, I think the studies all show that as an individual investor versus an institutional, individual investors are always the wrong time.
Well,
they're making decisions based off emotion, rather than based off of the kind of the trends of the market and following the math of it.
Right, it's more of the herd mentality, and when you look at the Dalbar studies, that year after year they repeatedly show that individual investors get somewhere between maybe 3% and 4 or 5%, total, return, where the market may be returning 15%, as a whole. So
it's just they don't know when to get in, when to get out, unfortunately, and that's the truth of kind of.
So the big question really is, if we turn to annuities in a bear market, or prior to a bear market, or during a bear market, it's better to get into it before the bear market hits because you got all your money intact. Can we expect strong growth from annuities if we go into a bear market?
And it's a great
especially
question.
Indexed annuities,
I was going to say
hybrid style.
If you talk about any fixed type of annuity,
yes.
All right, so let's just focus. Either you've got a fixed return, which is 2, 3, 4% perhaps, as opposed to going down 10, 20, 30. That's an extremely good growth percentage.
Well, now, 2008 was a 40% drop.
I would take my 2 or 3%.
I would take 2 or 3%. That's a 43% advantage.
So strong growth is a relative term, I think, here. On an indexed annuity side, and one of the things we always say, we like to participate in the market when it's going well. But we don't want to participate when it's going poorly. So if the bear is coming, wouldn't it be nice to put a floor underneath your investments, or
at least a portion of it?
Exactly.
Yes.
All right, let's put that there. So we'll take a 0 rather than a negative 40. 2008 people that got in before the bear.
So if you just happen not to make your 4 or 5% in the year that the market crashes and people lose 40% of their money, are you disappointed?
Well, I don't think so. And I think that's the mentality. Nobody likes the idea of getting a 0 when somebody, I could have put the money in a money market and made 0.2%. Well, all right. So a 0 in this case is going to really be your hero. And we say that kind of in jest, but it's when you compare it to the backslide that people are basically the other alternative. Even in a balanced portfolio, you're bound to lose something.
Well, Eric, back in 2007, 2008, I had clients calling me, thanking me profusely because their friends were in serious trouble.
Yeah, when they stopped bragging about how much they're making in the market,
and they were looking at their statements and they were still making money.
Yeah.
They were in shock because you talk about those things and it's kind of theory until it happens. Right. But when you see your portfolio surviving the storm and actually increasing, it's pretty dramatic. It's pretty impressive to you personally.
Well, and this is where I like to the money you want for retirement, or you need for retirement, those dollars you want to use for future income. Yeah. Put some kind of safeguards behind them. The money you're going to use to hedge for inflation and go take big trips. Yeah, you can let those run with the bulls and the bears. And you hope that it over a period of time it does well.
Right.
But safeguarding a piece of it is definitely something that you want to consider. The other thing I want to mention is we've kind of had this advent of these different low volatility indexes that are not necessarily correlated just to the market. They're designed to do well in kind of varying types of economic environments, and not so much reliant just on the S&P.
Correct. So, well, even if we go back to the other crisis, like in 2008 or whatever, And all we had at that time were the volatility indexes, not the volatility, but like the S&P and the Dow Jones, that type of thing.
Yep.
Even then, the annuities, indexed annuities, performed well. I mean, because, yeah, they had 1 year they were a zero, but they reset at the lower point.
Right.
The market had no place to go but up. And so they were making money consistently with no risk to their principal.
Yeah, it's nice when you get that reset at a low point, so you're actually going to be bound to make more interest credited from that low point.
Right.
And you get to ride it up, even though a lot of people that were in the market solely haven't even gotten back to even
yet.
Yet.
And now, like you're expressing with these low volatility, non-correlated type market indexes, you can actually be making money when the market's going down.
They're going down, and you just keep kind of chugging along. It's trying to hit singles. We're not trying to hit home runs
exactly.
here. The more singles we can hit and be consistently getting a little bit here and there.
Well, and this is a good time for those folks that are in retirement or near retirement to say, you know what, this isn't just about avoiding this market crash or bear market or correction that's coming. This is really more about my long-term retirement. So this is a good time to actually dive into true retirement planning and do financial planning that says this is going to meet my retirement objectives at a good time.
And this is what I can't recall the exact saying, so I'm probably but sometimes you eat the bear, sometimes the bear eats you. I think for annuity owners, sometimes you can eat the bear.
I agree.